Welcome to It's the Economy. As we just said, tomorrow's monetary policy is uppermost, although CNBC-TV18's Citizens MPC and what you just heard, my colleague Ritu Singh's poll, both indicate that the market is not expecting any change to rates and mostly no change to the stance either. Then what will the markets watch out for? Which part of the governor's statement and Q&A could move the market? For these questions, I have with me two actually market experts, Abhishek Upadhyay, the senior economist at ICICI Securities PD, and R. Sivakumar, the net fund manager at Axis Mutual Fund. Gentlemen, thank you very much for your time indeed. Abhishek, first, the ground questions. What do you expect RBI to do with inflation forecast? As you know, our own poll indicates that for July, inflation could be anything between 6.5 and 6.8 from the poll I did. Your thoughts on what RBI will say?
So inflation in July, we expect a 6.8% kind of inflation, and inflation for July-September is tracking above 6%. But from monetary policy standpoint, I believe, from this policy, there will be focus on what RBI says about H2 inflation, and also for what projection they give for April-June 2024 inflation, which will be put out in the monetary policy document this time. Our own sense is that while near-term inflation is high because of vegetable prices, the outlook for H2 inflation has not changed materially. So we think that because core inflation momentum has been so soft with a 3-month annualized rate actually at 4.5% and below the YY measure of core inflation, even if there is some upside risk to food inflation, overall inflation can still be quite close to what RBI penciled in their forecast last time, which was around 5.3% average for H2. Possible this number can be tweaked slightly higher, but we don't expect material change. Even more important, April-June inflation, which RBI indicated in April would be close to 4.5%. That will be closely eyed. Again, our sense is that number should continue to be below 5%, given the inflation internals we have observed, and given some of the risks we were talking about earlier from monsoons, etc., have really not crystallized. Yeah.
No, what is your what do you expect RBI will say? Will they up the full year forecast to 5.3? Will they up the, as you say, April, May, June forecast for 2024 from 4.5 to what, 4.7 or something? Is that what we should be prepared for?
Possible for H2, the RBI revises its forecast by 20-30 basis points higher towards 5.5% or so. And for April, June, again, maybe they give a number between 4.5 to 5%, but no material change. If we get these numbers, it would signal and it would provide a cue to bond markets that RBI is likely to be on prolonged pause rather than leaning towards a hike, which is what is priced into the swap curve currently. Swap curve is indicating a good probability of a hike by, say, the December policy, which we still consider to be quite a low probability event.
Oh, this is big. I didn't know the swap curve is actually pricing in a hike. Then the reaction could be very different tomorrow. Sivakumar, good morning. Thanks for joining. What's your sense? What is priced? Is it true that there are sections which expect a hike by December? And if the number that RBI puts out on inflation, full year inflation, if second half is up by 20-30, full year can go up even more. It can be a 5.5 full year. And 1 year ahead could be probably, 4.7 or 4, whatever. If these are the numbers, how will bond markets react?
Yeah, first of all, good morning and thanks for having me on. I think the most important thing is that inflation is still tracking roughly where RBI expects it to be. So yes, on food inflation, there's likely to be some upside marked to their inflation forecast, but I think that is something that the RBI will look through. They have looked through in the past. So unless they fear that this becomes generalized, this is not something to worry about. We must also remember that the RBI is working with an oil number about 85, which is, despite the rally in oil prices, is still where it is. So there are other parts of the RBI's forecast on inflation, which is kind of bang on relative to market movements over the last 2 months. So I think the RBI is poised to stay flat. Having said that, I completely agree. There are segments of the market. If you look at swaps, it does indicate that the market is preparing in some sense for one hike in the next 6 months. I don't think that RBI will deliver that hike. I think RBI is mostly done. The risk is if they change their view and they believe inflation becomes generalized. That's one risk. It's a very low risk. The other risk which we need to definitely keep in mind is if the Fed puts in a September hike or later, then the RBI may want to consider keeping a spread to the Fed and keep rates elevated. So I think the market in some sense is trying to sort of play that game, that will the RBI react to an expected or to a potential September Fed hike.
Okay, so if they indicate that they are not doing that hike tomorrow, we could have a bond Diwali. I mean, you could see yields going down to 7.12 or 1 or anything like that.
Right now, if you look at the global environment for yields, it's definitely on the harder side. So we have, of course, the US 10-year has retraced significantly from the close to 420 levels that we saw earlier this week. Most of the bond markets seem to be catching a bit of a bit. But the underlying worry is that central banks are not done tightening. The move in Japan to loosen yield curve controls again has pushed yield expectations higher. So in the very near term, even if RBI holds its policy rates and the stance, I don't think we should see a significant move in yields. I think markets will wait for the next few months before that kind of a movement happens.
Okay. So the big point is, and we will all be asking the governor that, what are the chances of it becoming generalized? Abhishek, for that, some growth or aggregate demand numbers will also be watched. Do you think RBI will change its GDP forecast of 6.5%? Do you think there are upside risks to that number, given the very strong tax collections, very strong core sector numbers, and higher than expected growth numbers even in the US, quarter after quarter, month after month?
So RBI again is in a good place in terms of the ability to retain their growth forecast. We know that RBI's growth forecast has been higher than market forecast, but based on the GDP growth data for the Jan-March period that we got earlier and the high-frequency data, and add to that narrative of soft landing globally, most analysts have been revising their forecast up towards RBI projections. Still broadly, I think in our view, growth this year will be closer to 6% only. There is still a lot of uncertainty about how global demand will evolve. And our sense is with exports weakening, they can exert significant drag to this year's growth outlook. But from RBI's standpoint, don't see any push for them to again change their growth forecast. I think Latha, one point
you think they will
on.
Go ahead, but also tell me whether you are expecting them to say things can get generalized. Please go ahead.
No, so don't expect them to say that inflation outlook has changed materially yet. So far, it is only vegetables. And if you look at inflation internals for the last couple of months, core inflation has been quite soft. In food inflation, there are pockets of concern, but broadly, thematically, as I said, monsoons have evolved more favorably than what many of us would have feared. Also, global food prices, while they have gone up a little bit, but still remain broadly well behaved. So as long as food prices are not going materially higher, and we don't get a new source of shock to domestic food inflation, don't expect them to say that price pressures are at the risk of getting generalized yet.
Okay. Sivakumar, all right. Now, you train our eyes. What will we watch out for, or what would you want to watch out for in the speech and in the Q&A? Liquidity, anything. What would you watch?
The RBI has, in that sense, been very interventionist in many places, right? So I think the most important thing is FX. The reality is that they have been intervening, they've been adding significantly to liquidity over the last several months. First through the demonetization of the 2000 rupee notes, a lot of money came into the system. And then now large-scale intervention in forex markets to stop the rupee from appreciating, which has again added significant amount of liquidity to the system. So I think liquidity is something we will watch for. They are very clear that in this withdrawal of accommodation stance, they would not want liquidity to get easy. So we obviously will be watching to see what they fail. I would expect they would not fail much. So to a large extent, this policy, I think, should be a non-event, non-controversial policy. And the surprise would be if they change any of these statements, either around liquidity or around the stance on rates, any of that. If they change, I think that will be the real surprise that we should be watching for. Otherwise, we should watch for much of the same. I would like to also sort of draw attention to one important thing, that the growth outlook for the RBI is very important. I think a lot of the reason that they have maintained the monetary policy stance the way they have over the last few years is to ensure that growth is supported. So because of, let's say, global environment, we saw the trade data out of China. We've seen some incremental numbers in the US indicating some kind of slowdown. If that kind of results in the external sector slowing down materially, I think second half of the year, we should expect RBI to tone down its language. It's too soon for tomorrow, but it's certainly something that we should be watching for in the next year.
Okay, a lot of people are actually on the other camp, actually, that growth is in fact stronger than what they expected. Abhishek, a similar question to you. The consensus is that RBI is going to sound, will not change anything, but sound hawkish. You tell us what we should watch out for.
So in terms of the template, they will follow a similar template as the previous two policy meetings, where they retain the key policy settings, but continue to sound hawkish, both to retain that optionality to hike and also to preclude any premature easing in financial conditions. One thing, we are watching closely is potential action on the liquidity front. It has been somewhat puzzling that RBI has continued to add liquidity through the FX route, despite there being a sharp influx of liquidity on account of the recall of the 2,000 rupee notes. And core liquidity surplus, actually, if you compare to last policy, is higher by 1 trillion. Still, if you look at the weighted average call rate, which RBI tends to look at more closely, it is quite closely aligned with the repo rate. But there is that outside possibility that they could announce some sterilization measure to withdraw some of the core liquidity surplus that has been built up since last policy. Not our base case, because we do think core liquidity surplus will dry up by the end of fiscal. But there is that risk that they may take some action, perhaps a FX swap auction, to suck out some of the FX liquidity they have injected over the last couple of months.
Oh, okay. In which case, the markets can be a little upset, I guess, the bond markets. Gentlemen, out of time, thank you very much. We will seek your help to understand how you parse the governor's language. This time tomorrow, he would have delivered a speech. So we will want to know how he parses. But only on liquidity, a lot of bankers tell us that now you have this 24-hour NEFT, and therefore they need some at least 1 lakh crore at a system level just to meet those payments. So at least I would like to know, what does RBI mean by balanced liquidity now? 1 lakh crore is par for the course. They need to keep a little more than that. So over and above that, if they withdraw this liquidity, Abhishek, then maybe the market will take it as hawkish. But all those questions tomorrow to you and to a whole lot of experts. Gentlemen, at the moment, markets very placid, bonds as well as equities. Equities actually a little downbeat. We'll wrap up on Bazaar on that note. Chartbusters up next.